Stock Play of the Day is an educational program. Any statements made by Ally Invest employees are not intended to be or should be considered investment advice, a recommendation to buy, sell, or hold a security, or a recommendation to adopt an investment strategy.
Hello and welcome to the Stock Play of the Day. Today's stock is Deere and Company. Good old John Deere. We'll discuss, should we pass or should we play? Hello, my name is Brian Overby. I'm the Senior Options Analyst at Ally Invest.
And I'm Lindsey Bell, Chief Investment Strategist at Ally Invest.
All right, Lindsey, I have a chart of the S&P 500 index up. Once again, a little bit uneventful as we are approaching another new high in the S&P 500 index. What's going on in the markets this week?
Yeah, that's right. We're up for the second day in a row, looking for another new all-time high, like you mentioned. But like we've been looking at for the last several weeks, is that 50-day moving average trend line, the red line on your chart right there. It has been a steadfast floor for the stock market for the last several months. In fact, we'd have to go back to what looks like November on your chart there for it to have closed below the 50-day moving average. Closing price is what I'm talking about, for 2 days in a row. So the last time it's gone that long without closing below the 50-day moving average for more than 2 days was 1996. So we are in a strong uptrend here, Brian. This week we're getting a lot of economic data. Some of it so far has been mixed. We got new home sales this morning, which were pretty solid. There is still concern about where the trajectory of the housing market is going, because on a year-over-year basis, new home sales were down pretty significantly, more than 27%, but they were up on a month-over-month basis, which is good. We still have really low interest rates. Inventory is low. It actually picked up a little bit, but overall still low. So that's impacting the housing market. On the earnings front, we continue to get retailer earnings. Best Buy reported, and it was a really strong report. Another retailer reporting top line and bottom line beats, and they're raising guidance for the rest of the year. We've seen this from several companies, including Walmart, Target, Macy's. The list goes on. The consumer, in other words, still remains in a position of strength. They're much more financially sound than they were prior to the pandemic. And so that's a positive in the economy. Some other movers this morning in the stock market, we got Palo Alto Networks. They're jumping on their earnings report. CrowdStrike's being added to the NASDAQ. So you've seen the NASDAQ move much higher this morning as well. On the Delta variant front, the latest news is we're starting to see cases decline in China. They took a very hard stance to really rein the new variant in. So you're seeing signs of travel pickup over in China too. So hopefully that bodes well as we navigate the Delta variant expansion here in the U.S. and what that means from a reopening perspective. So those are all kind of the big things that we're watching. But Brian, again, we always like to look at the VIX, see what's going on there. I think we crossed 20 for maybe one day last week, but we've been really kind of in these subdued high teen levels. What are you seeing?
Well, if I look at the VIX, one of the things that is noticeable this morning is that we have the S&P 500 index up a fraction, but it is up. It's up $6.74 on the day, less, about 0.1%. But if we look at the VIX index, we also have that up. And that could be the news of the Fed announce what's going to happen on Friday. The Fed is going to speak on Friday. And a lot of times when you have that uncertainty in the marketplace, it will drive up a little volatility. So most of the time when you have a flat or an up day, it's very odd to actually see the VIX go up. And at this point, it's up about 1% on the day. If we go out to the October and November futures, and I mentioned this on a lot of the stock plays of the day, we're seeing the October future trading at 2170. The November futures contract trading at 22.55. December also above that 20 level at 22.78. Just showing that going into the end of the year, the marketplace is expecting more volatility than less, based off of where the current market is at right now. Not to mention September and October, we're there, normally known as more volatile months in the marketplace. Once again, there's no actual rhyme or reason behind why the September and October months should be more volatile. But with that said, if you look back over the years, you still see a lot more volatility in these months. Marketplace, as far as the VIX is concerned, on the futures contracts, is saying yes, we think that it will be more volatile going to the end of the year, but this has been the case throughout this entire year so far in 2021. We've seen the VIX futures still stay elevated. Where we've had a little bit of change in the actual spot index, came down for a while, traded right around that 15% level, which ideally would be a more normal volatility in a bull market like we've had, where we just continually set new highs without a lot of volatility. Actually, the actual volatility is fairly low in the S&P 500 index relative to where the actual VIX index is and where the futures contracts are at. So up day in the VIX, up day in the markets. What do you think of that, Lindsey, overall?
Yeah, I think you're onto something with the Fed, because we've got the Jackson Hole Symposium at the end of the week. Chair Powell is going to speak on Friday. All eyes are going to be watching him, looking for any indication of what a taper of their bond purchases can look like, and the timing of that. Especially, like I said earlier in my commentary, we are still getting some mixed economic data, and so the market has really kind of been. We saw last week the Fed moved the market to the downside as they began to talk about the potential for tapering later this year. And so the market has a little bit of anxiety about this. But if data, we also get on Thursday, the PCE inflation indicator, which is the Fed's favorite gauge of inflation too. So that's going to tell us where we are from an inflation standpoint before we hear from the Fed chair. And that, along with jobs, are the two areas that the Fed watches most significantly when determining what their monetary policy is going to be. So when they might taper their bond purchases or when they might raise interest rates. And inflation has been running hot. You usually need to raise rates to combat inflation if it runs too hot for too long. But the jobs report, I think, in August is going to be a really big key indicator for the Fed about what their next steps are, or at least what the timing of their next steps are, because I think we know that tapering is coming, and really it's just a matter of when it's coming at this point in time. So we're going to keep an eye on that August report, which we're going to get next Friday. And the expectation are that we're going to see a significant number of jobs added, unemployment ticking down yet again, but still remaining relatively high versus historical averages. Either way, it's more likely that the Fed's going to be willing to drag their feet, take their time on tapering if the picture is mixed, especially from a jobs perspective. Also, we're going to start finally cycling some of those inflation numbers that become more normalized in the months ahead too. So I think that's going to be a telltale sign. Doesn't mean they're not going to taper at all this year. It just might not happen until later in the year. Anyway, I think that's why you're seeing the move in the VIX. There's just a lot of uncertainty around that, and seasonality. You mentioned that too, is also a very good point too. So we'll just be keeping our eye on it. You know, the one thing that I got to say, Brian, is we are in a buy the dip type of market. That's why the 50 days becomes such a strong floor for the market too. So we think that should continue to hold, even if we see a little bit of distress in the months ahead.
Right. And a lot of people are talking about the buy the dip market, but not a lot of people are talking about the infrastructure bill. You notice there's so many headlines that are out in the marketplace, but that was a pretty big bill that came out that defines infrastructure, and hence the reason why we're going to talk about John Deere today. Now, John Deere is a fairly high-priced underlying, and that kind of fits well in the options world. We have a $365 stock, as you see from this chart here. It's not a very exciting chart, except for the fact that if I look at on the chart, once the infrastructure bill was announced, we did set a new high, came all the way up to about the 400 level. But as you see a lot with round numbers, the market has a lot of times stocks have troubles breaking through to new highs. And then we've came down precipitously since then, all the way down to about the 320 level. So we have about an 80-point range in this newly established channel in John Deere. So on a charting basis, we did just break up above the 20-day moving average today. So we had a little bit of an up move today. And we do have these in line in a good stack right now, if you will. We have the 200-day, then we have the 50-day. And if we break above and stay above the actual 20-day moving average overall inside the channel, that's good news. But it is in the middle of the channel overall. So kind of looking more so on the long term on John Deere. I know they recently announced earnings. What's your outlook on John Deere, Lindsey?
Yeah, before I get into the fundamentals on the stock, I just want to remind all of our viewers that Brian and I are going to take your questions live at the end of this little review of the actual stock. So please feel free to type them in the box on the right-hand side of the YouTube channel. We'll get to as many as we can at the end of the show here. So now looking back at Deere, looking at that chart, like Brian said, it's actually come a really long way really quickly over the past year. And in the last 6 months or so, we've seen a little bit of digestion to a bit of a pullback. I think the stock is kind of trying to find directions while investors really grapple with what growth next year is going to look like. Brian, you mentioned the infrastructure bill. We've got a headline out today that while it was passed, the $1 trillion infrastructure bill was passed through the Senate on August 10th. The House was supposed to vote on it this week, and there's been a delay in that too, which isn't necessarily a bad thing, because sometimes when the government is in a standstill like this, or a stalemate, you could see actually the overall market do well because there's no massive change coming. But I think overall, the market really does anticipate that we're going to get some sort of infrastructure bill, more stimulus added to the economy, and stocks like Deere are going to be ones that benefit. So looking at the stock last week, like you said, they reported earnings at the end of the week. On August 10th, the Senate passes their infrastructure bill, passes it to the House. The stock peaked on August 11th and fell 9% on a closing basis. You see that big down move on the right-hand side of the chart here. And that was, it was a sell the news type of event. People had anticipated this was coming, and allegedly it was priced into the stock. Well, then these guys report earnings at the end of the week. And you know what they did, Brian? They beat on a top and a bottom line. It was just a solid report across the board. They raised their 2020 outlook. They're now estimating that net income is going to come in at $5.8 billion. That's up from the $5.5 billion that they were previously guiding to. So it's a good story here. We saw really strong pricing in the report. The margins expanded. All sounds well, seems to be going well for the company. But again, investors are really looking past the current quarter, the past year's successful earnings reports, and looking to see what is growth going to look like next year. And that's where they're kind of having a hard time reconciling things. But if I look at what analysts on the street, Wall Street analysts, are predicting for their 12-month price target on the stock, they're at about $409. So it's 11% up from where we are today. And from a valuation perspective, I always talk about valuation because I don't like overpaying for something. I'd rather get a deal on something. And this is a stock it's trading at 17.1 times its forward 12-month earnings. And that's a discount to its 5-year average, which is about almost 19 times. So that's a pretty decent discount. And really, I think when you look at the industrial sector overall, a lot of these companies, the infrastructure bill hasn't been priced into actual earning results. So I think earnings could come in better than what is already out there and anticipated by the marketplace once this $1 trillion is factored into the system. And if that is the case, that means earning estimates are going up. That means that the stock is even cheaper on a forward earnings basis. So that's something to consider when looking at this stock. I think, like you said, we are getting into a seasonally questionable period for the marketplace in general. So September and October, you could continue to see some volatility in this stock as well as in other industrial stocks, but I think it's worth a look. And that's where an option play could look interesting, because you don't have to just straight bet on what the stock is doing. You can hedge it. So Brian, how would you do that when you're looking at an option trade?
Without a doubt. So let's start by looking at our option chain and see what John Deere is doing today. We see it up 2.6 points today, almost 1%, trading at 365.41. So John Deere is an interesting play for options because of the fact that it's a fairly expensive company. The more expensive the underlying stock, the more expensive the option contracts will be in general. And so if you're thinking about buying 100 shares of stock, you're talking about $36,500 some odd dollars to do that. So how could we use that option contract to go on out and reduce our risk, but still have a toe have a toe in the water, if you will? We've had a big run up. We're in the middle of a channel. We're going to go out longer in time. We got September, October, end of the year, all these different issues that are going on. And we're going to buy an in the money long call option. And so inside the options playbook, I'm showing you a profit and loss graph of a long call in general. The downside is limited and known to the premium that is paid for it. The upside is basically the same as owning the stock, except for you're going to have a little bit further break even. We're going to be down the break even, or down the x-axis a little bit for our break even point, because we are buying an option. There will be some time premium in it, and we're going to buy an in the money option contract. Now, if that term of buying an in the money contract kind of scares you a little bit, you might want to read the Rookies Corner inside the options playbook. We actually highlight a section that's called buying leaps calls as a stock substitute. Now, leaps is just a fancy marketing term picked out by the Chicago Board Option Exchange. It just means longer term options. So we're not going out 9 months, 12 months in time. We're only going to go out till January of this year, which is 150 days. We're going to go a little deeper in the money, which this talks about inside the Rookies Corner of the options playbook. And we're going to just buy an option contract and see what happens with John Deere. So going back to the Ally Invest option chains, on the left-hand side, we have the calls. Here's the January 21st expiration, 150 days out. We're going to look at about an 80 delta. I'm actually going to choose the 74 delta here. Part of the reason why is we have a little bit of volume in it, a little bit of open interest. And to be blunt, if these markets were a little bit tighter overall on longer term options in general, especially on fairly expensive stocks, I think you would see a lot of people be doing the strategy as an alternative to buying 100 shares of stock outright. So in this instance, we have a market, it's a little less than $1 wide. Obviously, the stock is a penny. Well, in this instance, we're actually about 15 cents wide. So relative to the stock price, the options are always going to be a little bit less liquid than the actual underlying stock, just because there's so many options to choose from overall, and the volume gets spread out amongst those option contracts. But it's not bad for a stock like John Deere. So it's an interesting alternative. You got to battle with the bid-ask spread. You got to kind of work it a little bit. And I always have to emphasize here on the stock play of the day, this is not meant to be a recommendation. We're just looking at situations where plays inside the options playbook might be interesting as an alternative to actually trading the stock outright. And here's a real good example of one. So we're going to limit our downside by buying this option contract, but it's a real option contract. 47.75 on the ask. So you're talking about $4,775. But that's going to be our limited risk on the downside. That's the maximum that we can lose no matter what happens on this trade. So if we go down on the workbench, we see the bid right now is $46.95. That's your sell price. If you just bought it at the market, it's $46.70 or $47.75. I'm going to put it in the right rail. That means it's going to be our official paper trade for this week. And I'm going to work it a little bit. I don't want to just jump out and pay the ask right away. I kind of want to see where the market is at. Never a guarantee of a midpoint fill, but I'm going to give them a little bit. In other words, I'm not going to just try to put it in right at 47.33, right at the midpoint. We're going to go up and we're going to give them 40. So 47.40 is the price that we're going to start at here on our long call, in the money call option overall. And that means we'd have $4,740 worth of risk. Now, I always have to talk about this one, and I mentioned this a little bit in the buying leap options overall. One of the things that's nice about buying an in-the-money longer-term option contract is that as the stock goes up, you actually gain acceleration. You gain what's something that's called delta. The stock starts acting more, or the option starts acting more and more like the stock as it gets deeper in the money. Okay. Another way to say it is that you get more stock price representation. But if the market comes down, it goes down slower than the underlying stock. You lose delta. That means if it's going against you, it goes against you slower. So we have a natural stop point if we put in our long call spread. If the stock gets to 330, our strike price, got to consider getting out. If that happens, that would become an at-the-money option contract. And let's look right now at what an at-the-money option contract is. We have the 370 strike call option trading for 22.65 by 23.20. Okay, so let's call it $23. So this is implying that the stock is currently trading 365. So right in the middle of this, if the market came down and made this an at-the-money option contract, in theory, we're going to be trading somewhere to where the most at-the-money option contract is at right now. So on the way up, we go up faster and gain momentum on the way up. And if we're incorrect on our forecast and it comes back down, we have a natural buffer by buying deeper in the money, longer term option contracts. Now, obviously, this is all in theory, and this is as of today. As the time decays, we still have time erosion in our option contract, and that's going to change things up a little bit. But I like this as a strategy on a stock that has had a good move up. Obviously, in the last 6 months, John Deere has done a lot of good, received some good news about infrastructure overall, but there's still concerns about the bill just a little bit. So how can I participate without putting in all the capital from buying 100 shares of stock outright? And I'm emphasizing that on 100 shares. Normally, if I would buy 100 shares, I'm going to buy one call option. You might get a little frisky and maybe buy two because you can afford it. But the theory here is that if I'm normally going to buy 100 shares, I'm going to buy one call option that represents 100 shares. And I'm not trying to use the leverage factor as much so in options. I'm trying to use options more as an investing tool, if you will, overall. All right. So that's my summary. I'll show the profit and loss calculator here, but please put some questions in the chat box right now. Lindsey and I are ready to take them. I'm going to highlight the profit and loss graph. I'm going to zoom in a little bit here. And all I'm going to show you is that this looks very similar to the actual options playbook for a long call, except for in our profit and loss graph inside the Ally Invest option chains, you see as of today. So the colored line is as of today. The dotted line is at expiration. Inside the options playbook, we only show you at expiration. And this kind of highlights the fact that you can see as the market goes up, which I was trying to explain, but the graphic does it much better. We gain acceleration. It starts acting like you own stock, which is basically right at the expiration, dot line. Okay. On the way down, you see this little pillow to land on, this buffer area. Now, as time decays, well, yeah, that colored line is going to start approaching the dotted line, and we'll go down. We'll make it dramatic. We'll go from 150 all the way down to 10 days to expiration. And now you see that we're acting a lot more risk at the end than at the beginning if the market actually makes a downturn overall. And that's what I was trying to emphasize by talking about buying that deeper in the money option and the acceleration factor that goes along if you're correct, and the deceleration if you're incorrect on your option contract. All right, so I see a couple of questions in there, Lindsey. I'll pass it back to you and let you choose which one you want to answer first.
Yeah, sure. I think Raman AR is being a little bit of a jokester. Good luck, Deere. But But then we also have William Mitchell says, why not selling out of the money Jan 21 call at 370 to reduce the dollar amount invested?
Well, and that's an okay way to approach it. But what you're talking about would then create what's called a long spread. And you can reduce that. But the one thing about long spreads, that time decay factor is fairly important. If you're correct on your forecast and you're going all the way out to January, a lot of time, what you need to happen is some time decay to happen. So if I'm using the January contract and I sell a further out of the money call against it, I cannot get the maximum on that trade until I get a little bit of time decay on that call that I've sold. Why is that? Well, when you sell a call, the call wants the market to go down that we sold. If you buy a call, you want it to go up. So they fight each other until they get closer to that expiration date. So here's what I would suggest, and just a little tangent off of what William is suggesting, is actually do what's called a fig leaf inside the options playbook. So let me pull this up real quick. I'm going to go to option strategies. And this is actually a strategy that we named in the options playbook. It's a very, very common and used strategy. But one of the things about it is nobody ever named it. So this is actually an alternative to a covered call. The fig leaf strategy highlights that we're going to sell a shorter term option against it and try to bring in some capital to help offset some of the time decay. But we don't have to wait as long, if we're correct on our forecast, to actually get paid out. We don't need that time decay to happen on that longer term basis, which is a much slower rate of decay relative to a shorter term trade against it. So a lot of people will reference this as a leverage covered call. I'm buying an option as a substitute for a stock. Let's sell a shorter term option against it. So this is an alternative to do. And if you want to learn more about it, obviously check it out in optionsplaybook.com. And with that said, though, you also want to read about managing your positions, because the reason why we call it a fig leaf is that you're kind of covered in that I don't own the stock overall. So if the stock went up and it went through my strike and I got called away, I just give them the stock that I own. I own an option. So I am covered as far as the brokerage firm is concerned, but I'm going to have to do something if I get assigned. So the one area that I want to talk about is you want to avoid assignment if you sell a shorter term call option against your longer term option and you're approaching that short term strike. So what do we do here? We want to look at rolling a covered call. And that's going to be required reading if you want to try to sell a shorter term option against it. It's fairly important to understand what's going to happen if that underlying actually reaches your call strike overall. All right, long-winded. Lindsey, do we have anything else that we want to cover?
No, we don't. I mean, I'll give folks another second or two to type in your questions if you have any. But that was really well done, Brian. And really, the options playbook is an invaluable source for anyone that's looking to or interested in trading options, no matter what level you are, from novice to intermediate or advanced. There's something in there for everybody. And a lot of it's free on the website, and you can buy it on Amazon.com too. So it doesn't look like we're getting any more questions, which is okay because we're almost at time. I think that we gave them such a great idea with Deere that it was a successful show today. William Mitchell says, makes sense. You've shown the fig leaf before. Thanks. It is one of your go-tos. I know that. But thank you, everybody, for watching today. Brian will be back on Friday to review this trade and suggest any adjustments based on where the stock moves this week. But Brian, I think that'll do it for us today, right?
Yeah, well, so please click subscribe, ring the bell so you get all the alerts for all of the stock plays of the day. Thanks for coming, everyone.